Very good morning, folks. At the outset, let me welcome each and every one of you for the Fast Track webinar series for CA Intermediate. Especially today's topic is going to be very, very interesting. And this is marginal costing today. Let us directly jump to the subject now. I'll screen share. Good. Once again, welcome back all of you for the Fast Track webinar series for CA Intermediate. This is paper 3, Cost and Management Accounting, chapter 14, Marginal Costing. And we are in day 2 of this Fast Track webinar series. All these videos will be available in YouTube. My request to each and every one of you, please subscribe, which is a free subscription, so that every update in my channel will be a notification will be sent to you, so that you can keep yourself updated with this topic. Now, let me take a few questions. But before that, I'll just share with you a simple concept in marginal costing. After that, I'll jump into the question. This is an income statement. And all of us know about this, especially in the last week we did about financial management. And in financial management also the same. We had sales less variable cost, contribution less fixed cost, then profit, that is profit before interest and tax. And after that, less interest will be profit before tax. And after that, less tax will be profit after tax. And after that, you will have a preference dividend, you subtract. You get profit available for equity shareholders. That divide by number of equity shares, you get earnings per share. This is the income statement, and we are not going for the second half. The first half only we are going to deal with today, especially this. And I want all of you to relate to this income statement, and I'll be only doing this. And especially, please look at this, sales and contribution. Okay, the contribution, maybe I'll put it in a color. This is yellow color and sales is green color. Okay, so this is your numerator and this is your denominator. So we call this as PV ratio. Okay, the profit volume ratio, PVR. Okay. Otherwise, it's also called a CS ratio, contribution by sales ratio. I repeat, it is also called a CS ratio. So what is your PV ratio? Contribution, okay, divided by sales. So this is also called as CS ratio. Either you can call it as PV or CS. Why it is called profit? Contribution only becomes profit. So, and the sales is volume. So instead of calling it as PV, you can also call it as CS ratio. This is a very, very important, I will call it as a number. Why? Because the opposite of this, 1 minus CS ratio is your VC ratio, that is variable cost ratio. So why? Because if this is 100%, for example, sales is 100 and variable cost is 60, contribution is 40. So naturally 40 by 100 is 40%. 40 by 100 is 40%. So 60 by 100 is 60%. So it goes without saying that variable cost ratio and plus PV ratio is equal to sales. Okay. With this, we are going to do a lot. We are going to do a lot, especially. Please look at this. The first question. This is practical problem level. You are given the following data. Now, why I am doing this particular problem, please look at your May 2018. Somewhat exactly similar. And that is why I was very, very particular to you that in your study material, especially the practical problems given at the end, have to be solved fully and thoroughly. Line by line, word by word, every problem has to be solved. Exactly the same model. So please look at this. So I'll try to do both this. You are given the following data for 2000 X8 and 2000 X9, sales and profit. So what I will do, I'll just copy the same. Okay. Good. So this is my income statement. Good. So I will say this is which year it is? 20X8. So 20X8 and then 20X9. So these are the 2 years that has been given to us. So this is your income statement. Good. So now let us understand this slowly. Good. So what is your sales? 1,20,000. Okay. So the entire thing. So 1,20,000. Good. And for 2020 X9 is 1,40,000. Just put this in this vertical always. Profit is 8,000 and 13,000. This is 8,000 and this is 13,000. Good. Now, please understand that if your contribution increases, contribution is an increased proportion to sales. Because as sales increases, contribution also increases. So therefore, the relationship between your and if your contribution is increases, profit also will increase exactly the same. Exactly the same. Why? Because fixed cost is same. If your contribution is 40 and your fixed cost is say 35, your profit is actually 40 minus 35. Now instead of contribution 40, it is 60. Fixed cost is same 35. And your profit is what? The same. Your contribution minus fixed cost. But please look at the incremental contribution. What is your incremental contribution? 60 minus 40. So 20. Look at the increase in profit. 25 minus 5. So meaning increase in profit is equal to increase in contribution. Increase in profit is increase in contribution. So therefore, instead of calling it as contribution by sales, you can call it as incremental contribution by incremental sales or incremental profit by incremental sales. That is also PV ratio only. Because contribution is profit. Change in contribution is change in profit. Okay, good. So that is the logic at which we are going to do this. So what is your change in sales? Your change in sales is 20,000. What is your change in profit? 5,000. Actually, change in profit will be the change in contribution. Just now we saw, no? We just know we saw. The same change will be there. Profit change will be our contribution change. So they same change. So if there is a 5,000 increase in profit, there will be 5,000 increase in contribution. So contribution is 5,000, sales is 20,000. Okay. So for the increase in sales, the increase in contribution is 5,000. The increase in profit is 5,000. So therefore, your PV ratio is equal to your contribution by sales. 25%. Wow. So this is your first answer. What is your question? What is PV ratio? Okay. Now, what is your break-even point? Let me add one more column because the break-even point is one more column. Why? Because you have a profit here. I will have one more column here. Okay. This column, I will call it as a break-even column. Okay. BEP. BEP. Break-even. What is the sales? We don't know. But profit is 0. What is it? Profit is 0. All of us, we know the profit is 0. Very simple. And the fixed cost will be same. And fixed cost will be equal to contribution. I repeat, fixed cost is equal to contribution. So now, once all of you know this PV ratio, just apply. Once you know the PV ratio, you will know the variable cost ratio. What is variable cost ratio? 1 minus 25%. So therefore, your variable cost is 75%. Okay. And your contribution is 25%. Good. So now what is 75% of 1,20,000, which is 90,000. So 120 minus 90 is 30. And what is fixed cost? Naturally 30 minus 8,000, that is 22. Same should be for even, so your fixed cost is going to be fixed here also. Now let's find out here. On 1,40,000, 75%. So what is 140 minus, what is it, 105? And what is 35 minus 13? 35 minus 13 is 22. So fixed cost is 22. So therefore here also contribution will be 22 because contribution is equal to fixed cost at break-even point. And what is your break-even point? Your break-even point, all of you know, it is fixed cost divided by PV ratio. Why? Because this is 25%. So what is 75%? On this 3 times. So what is your contribution? 88,000. So that is your fixed cost divided by 25%. That is PV ratio. So which is 88,000. So 88 minus 66 is 22. So your fixed cost divided by PV ratio. So 88,000. Rupees 88,000. Remember, this is rupees 88,000. Sometimes break-even point in value. Okay. Generally, break-even point means units only. Break-even sales means in value, in rupees. But here, per unit is not given. So therefore, in this question, break-even point and break-even sales both are same because there is no meaning in searching for a per unit data here. Okay. So it is break-even point means in value. You have to make that very clear. So this is 88,000. Good. So this working is most important working. Okay. So try to fill it up. And you have got everything. You have got everything. And you call this as working note 1. You call this as working note. Okay. Good. Now what is your next question? Profit when sales is 1,80,000. Wow. So what I will do, I'll add one more column. Okay. Maybe I'll add one more column. So for profit when say new situation. Okay. This is question number 3. Okay. 3. So this is 1, 2, 3. Situation 3 and your sales is how much? 1,80,000. Sorry. Profit when sales is 1,80,000. So 1,80,000 is your sales and your variable cost is on 1,80,000 is 75%. So 25% is 1,80,000 minus 135. Your fixed cost is 22. So naturally your profit is 45 minus 20. That's all. Straight away. So your 23,000 is your profit. So what is your question? Profit and sales are 1,80,000. Profit when sales are rupees 1,80,000. So what is it? It is 23,000. So you have to answer that itself. What is the next? Sales. So now when sales is 180, what is your profit? Now reverse question. What is your sales and profit is 12,000? Wow. So maybe I'll add one more column then. So this is your 4. So whatever the way we did this break-even point, the same we will do. So what is your profit here? 12,000. So 12,000. Okay. And for 12,000, my fixed cost is 22. Say forever 22 only. So naturally your contribution is 12 plus 22. 34. And 34 is 25%. So 34,000 divided by 25%. Or 34 into 3 times is variable cost. 34 into 4 times is sales. So 1,36,000 is sales, which is it is 4 times. On this again 75%. On 136, 75% is 102. So 136 minus 102 is 34. So 136 is your sales. So I repeat, 136 is your sales. So what is your question? Sales required to earn a profit of 12,000. Sales required to earn a profit of rupees 12,000. So what is the answer? It is 136. Good. So 1, 2, 3, 4 we have solved. Okay, now let's move on to, so this is your 1 and this is your 2. Good. So 3 is here, 4 is here. Now what is 5? Margin of safety. All of you know, safety means, remember, safety means you are above break-even point. If you are below break-even point, you are not safe. You are unsafe. You are making a loss. So naturally, you are in a safe region. Means you are above break-even point. And he's asking for 2000. Actually, it is not X4. I think some mixing has been done. Okay. So this is with respect to, the question is margin of safety with reference to, actually it is X9. Margin of safety for X9, 20X9. So what is your margin of safety for the year 20X9? So 20X9. And margin of safety is very simple. What is your distance between your actual sales and your break-even sales? So what is your actual sales for 2000X9? 1,40,000. Break-even sales is how much? 88. So 52. So the gap between how far, how much distance your safety, you are safe, how far from your break-even point. So 140 is your present sale. Break-even sale is 88. So the difference between 88 and 40, 1/40 is 52,000. Okay. So that is your margin of safety. Okay, good. So that is with respect to your practical problem 11. Now, the same question, but they are testing your patience with respect to May 18. So in May 18, what they did is, please look at this. It is not profit, but it is loss. One is a profit, one is loss. You have to be very careful. You have to be very careful. So therefore, this model will actually help you. This model will actually help you. So please look at this. I'm going to do question May 18 1C. Okay, May 2018 1C. So the same model, let me take this here. So what I will do, I'll just delete all these numbers. Okay, I'll delete all these numbers. Good. So now what you have to do, this is actually 16-17 and 17-18. 2016-17 and 2017-18. So this is your question. Okay. Now variable cost, fixed cost percentage, you have to find out. Let's find out. Now what is your 2016 sales? 4 lakhs. 4 lakhs. Good. What is 2017-18 sales? 5 lakhs. Good. What is your profit? It is actually loss, 15,000 loss. It is 15,000 loss. Here it is 15,000 profit. So you have to be very careful. You have to be very careful. Why? Because the increase in sales is 1 lakh. Or the difference in sales is 1 lakh. Similarly, the difference in profit is actually 30,000. Because a gap in between 0 is there. From 0 negative 15,000, from 0 plus 15,000. So actual gap is from minus 15 you have to come to 0. From 0 you have to go to 15. So 30,000 gap. Please be careful. Okay. Don't say 0. So therefore you have got it. So what is your PV ratio? That is your the sales, and all of you know that increase in profit is equal to increase in, I'll say increase in contribution. Both are same. Now contribution by sales directly. What is your contribution? 30,000 by 1 lakh. So which is 30%. So this is your first answer. I will say this is your first answer. So your question is profit volume ratio. So I repeat, your profit volume ratio is actually 30%. The next is your fixed cost. Now, all of you know your contribution is actually 30%. Once it is 30%, your variable cost ratio, all of you know it is variable cost ratio is 70%. So 1 minus 30. Okay, 70%. So your VC ratio is 70%. So now let's find out on 4 lakh 70% is how much? 280. 4 lakhs minus 70% is 120. Now, please have to be careful. You have to be careful here. Because 120 from 1,20,000, what if you subtract, you'll get minus 15,000. Naturally, it is minus of minus 15,000 is plus 135. From 1,20,000, if you subtract 135, you will get minus 30. Here also, you should get 1,35 only. Please look at this. On this 70%. Wow. So once you subtract 5 lakhs minus 3 lakh 50, 1 lakh 50. So 1 lakh 50 minus your 15,000 is 130. That's it. So fixed cost is same. Now, for break-even point also same fixed cost. Profit is 0. Your contribution is also same fixed cost. Contribution is 30%. So then this divided by 0.3, okay, into 70%. That will be your variable cost. Okay. The variable cost is 350. So naturally your contribution divided by 0.3 will be your sales. 4.5 lakhs. On that 70%, 3 lakh 15,000. 1 lakh 35,000 is your contribution. That is fixed cost. Subtract, you get profits. That is your break-even point. So what is your fixed cost now? Fixed cost is 135. Okay, 135. So we have got 135. So 135 is your fixed cost. All these are fixed cost. 135. Good. What is your break-even point? That also we have calculated. 450 is your break-even point. So technically, what is your break-even point? Even this is in value. Again, you have to make this very clear because the term break-even point means in units. Break-even sales means in value. But here, you can't find out in units. You have to mention it very clear. So therefore, it is actually fixed cost divided by PV ratio. Formula is automatic. Formula is by default. So normally, this divided by your PV ratio is your 4.5 lakhs. 4.5 lakhs is your break-even point. Break-even point in value actually. Break-even point in value. So sales required to earn a profit of 45. To earn a profit of 45. So now I'll start with profit 45. Go backwards. So your fixed cost is 135. Naturally, my contribution is 135 plus 45. And 180 is 30%. Okay. So then your sales will become 1,80,000 by 30%, which is 6 lakhs. So 1,80,000 divided by PV ratio, which is sales 6 lakhs. So on 6 lakhs, 70% is what? 4,20,000. 70%, which is 4 lakhs. So 6 lakhs minus 4,20,000 is 180, 135, 45. So now what is your question? Sales. 6 lakhs is your sales. Sales required to earn a profit of 45. So your question is answer is 4. This is actually 4. The break-even point is actually 3. So this is actually 3. Good. And your fixed cost is 2. This is your 2. Good. PV ratio is 1. This is your 1. Good. Good. So everything is the table only. That income statement. Okay. Margin of safety for the financial year 17-18. So where is 17-18 is here. 17-18. So margin of safety is your item number 5. I think item number 5. Yeah, 5. Because item 4 is here. So here there is no additional question. So what is item number 5? Margin of safety. Now all of you know that margin of safety means what is your present sale, otherwise actual sale, minus your break-even sale. So your present sale for which year? This is for 17-18. So 17-18% sale is 5 lakhs. Break-even sale is 4.5 lakhs. So your 5 lakhs minus 4.5 lakhs. So your safety is 50,000. Margin of safety 50,000. So margin of safety in financial year 17-18 is 50,000 in value. Again in value. Okay. Margin of safety in terms of sale value. Actually in value means in terms of sale value. Actually margin of safety you will also find in terms of percentage. I'll also do this. Maybe I'll do this here. Please look at this. What I will do, I will do this in percentage. There's also sometimes they may ask in percentage also. So the difference is 50,000 by present sales. So that means, please look at this. So 50,000 rupees sales out of your break-even from from your present sales. From your present sale, if you go down by 50%, 50,000, otherwise how much percentage? 10%. You have a safety margin of 10%. You have a cushion of 10%. Okay. If you go down by 10% from your present sale, you will hit the break-even point. Because from 5 lakhs, 10% is 50,000. From 5 lakhs, you go down to 50,000, you hit the floor. The floor is your break-even point. So you have a cushion. That cushion is 10% from your present position. You have a cushion of 10%. So higher the cushion, you are in a safety, more the safety. Higher the cushion, more the safety. So we can call this as the cushion. Very important. Okay. Margin of safety always in percentage. Always in percentage. For your kind information. Okay. Good. So this is your May 2018. Okay. The next question is, see, these are all the questions which will be very comfortable for you to solve if it is actually a single period or single product. I'll slowly take you to a multi-product, multi-period like that. So that is where the real challenge is. You have to be very careful. Now, please look at this. Practical problem number 6. Yesterday we did variance. Okay. And using variance, there is a question that has been asked. The company has 3 factories situated in north, east, south. Please look at this. 3 with its head office in Mumbai. Okay. With its head office in Mumbai, the management has received the following summary report on the operations of each factory for a period. So calculate for each factory as well as for the company as a whole, the fixed cost for each factory, break-even sales for each factory, fixed cost for the company, break-even sales for the company. Please look at this word sales. They have not said break-even point. Okay. So now let us see this. So we have the actual sales and profit. Please look at this. For north, east, south, we have the actual sales and variance. So, and since variance is given, it means with respect to budget. Okay. So let's do it very carefully. Let's do it very carefully. So this is for, I'll call it as income statement. Again, this is the same model. Model is same. I repeat, the model is going to be same. I'm not going to change the model at all. Okay, same model. Nothing is going to change. Okay. The only thing is, things are going to change with respect to, so this is income statement. What is this income statement of a company? So I'll call this as practical. What is the name of the company? I don't know. Company has 3 factories. So income statement of 3 factories. Okay. So what is the 3 factory? So variable cost, we don't know, guys. So what is the factory? It is north, east, south. Okay. So north, east, south. Now here I just want to make one more observation. This is income statement of 3 factories. I will call this as I'll call it as actual. Okay. The same. This is with respect to budget. Budget. Okay. So this is your actual, guys. And this is your budget. Budget. Now, what is your actual sales? Actual sales is 1,100 for north. Okay. So actual sales for north is 1,100, and for east it is 1,450, and for south it is 1,200. So maybe I'll take this bold color first. So 1,100, 1,450, 1,200. Profit is 135, 210, and 330. So 135 is profit, 210 and 330. For your kind information, income statement of in rupees thousands. This is in rupees thousands for your kind information. Okay, good. And they have given the variance. Guys, if the variance is minus 400, it means your budget is plus 400, 1500, because your actual is less by 400. Similarly, your sales variance is favorable, 150 favorable. Minus 400 means adverse. Plus 150 means favorable. If it is plus 150, that means your budget for each is less by 150. So it should be 1300. Similarly, for south, it is 200. So that means your budget should be more. That is why it is less. Similarly, profit. Naturally, there is a profit also, there is a variance is there. 180, there is a negative variance. So that means your profit should have been 315. Similarly, for east, profit is favorable, 90 favorable. So that means your budget profit is less by 90. So 120. Similarly, 110, your profit is less. So naturally, your budgeted profit is more by 110. This is very, very important. Technically, you have what is given to you is the change in sales and change in profit. So directly you can do the, what do you call it as, directly you can do what do you call it as the PV ratio. Okay, the change in profit by change in sales. Directly you can do it. So you will get the PV ratio very quickly. So what is your PV ratio? Your PV ratio is actually your change in profit divided by change in sales. We already know this. From the previous two problems, we did this. So by using this particular input here, we can directly find out what is your change. So what is your change in sales? You can directly do this. 180 divided by 400. That is your PV ratio for north. So for north, the PV ratio, okay, PV ratio is equal to, what is it? 180 by 400. 180 by 400, which is 45%. Okay. Similarly, for east, it is 90 by 150. For east, it is 90 divided by 150. 60%. Directly. This is very important. For example, what is this change in, instead of giving 2 period sales, they are given budget sales and actual sales. They are given budget sales and actual. And please ensure that the change in sales is equal to, I mean, what do you call it, as the change in contribution is equal to change in profit. So change in profit is equal to change in contribution. So change in contribution divided by your change in sales. So directly the variance is your change in sales. The profit variance is your change in contribution. Direct division. So this column is a very, very important column for you to appreciate what it is. So for south, it is directly 110 divided by 200. It is 55%. So now, if your PV ratio is 45%, what is your variable cost ratio? Variable cost ratio is 55%. Similarly, 40%. Similarly, 45%. So this is your PV ratio. I'll put this in green color. Variable cost ratio is cost. So therefore, I'll put it in red color. Okay. So what is your variable cost? And that will change, but I cannot put this here. But I want to make one more observation. I'll put a total. I'll put a total, and that total I want to put it in between here. So this is your total. Okay. So total. So what is your total sales? Your total sales is this, 3,750. Okay. And what is your total profit? So this is your total. This is your total. So what is your variable cost? Your variable cost is on 1100, 55%. Your contribution is on 1100, 45%. So what is your fixed cost? Your fixed cost is actually 495 minus 135, so which is 360. So I repeat that it is actually 360. So please look at the question. What is your fixed cost for each factory? Fixed cost for each factory and then break-even sales. So technically PV ratio and variable cost ratio is only your working note 1. This is working note 2. That's all. So these two are working note, guys. This is your answer. I'll say this is your answer. Now 360 you have got. 360 is for each factory. Similarly, find out for East. On 1450 variable cost is 40%. On 1450 contribution is 60%. Wow. So 870. So 870 minus 210 actual profit will be your fixed cost, 660. So 660 is your fixed cost for East. Now as and when you get it, you will get the total also. Okay. So you will get the total here, you will get the total here, you will get the total here. So please wait. You will find the actual. Okay. So this is your total profit, 675. So what is your variable cost for 1200? On 1200 variable cost is 45%. On 1200 your contribution is 55%. So naturally your fixed cost is 660 minus 330. 330. So your each factory fixed cost is 360, 660, 330, and the total fixed cost for the company as a whole is 1350. Wow. So we have got the answer for one. Now you need to find the break-even sales. You need to find the break-even sales. Now, how do you find the break-even sales? Very simple, guys. So very simple. So how do I do it? So what I will do, I will actually insert 3 columns. Okay, good. So what I will do, I'm sorry. So what I will do, I will change this here. So now you want to find the break even. Okay, so break even, what he says, for each factory find break even sales and also break even sales for the company as a whole. So this is actual performance. Okay. Now total I want to find. So I will add one more column. Okay. So I'll add one more column. Yes. So what I will do, I will now find the break even. So the break even. This is break even of north, east, south. I have to find. Now please remember, guys, if it is break even, it is 0, 0, 0. And your profit also will be, 0. There is no profit because for total break even, at break even point, company as a whole also may not make a profit. Good. So this is your income statement for 3 factories. Good, guys. Very good. This is the income statement. So now what is your fixed cost? Okay. This is your fixed cost. Yes. 330, 660, 330. Okay. So this is your fixed cost. I'm not going to change anything to your fixed cost. Now all of you know when at break-even point, fixed cost is equal to contribution. So 360 is equal to 360. 660 will be 660. And for south also it will be 330. Now remember, guys, your PV ratio is this. So what is your sales? Your sales is your contribution divided by your PV ratio, 45%. So 800 is your break-even sales. Similarly, for East, 660 divided by 60%. 1100 is your break-even sales. For South, contribution divided by contribution ratio, 55%. Wow. So what is your total sales? Okay. So 2005. So this is your answer. What is your answer? What is break-even sales for each factory? This is break-even sales for each factory. And break-even sales for the company as a whole, 2005. Other combination. So 800, 1100, 600, 2000. Simple. In one shot, you have done it. Everything in one shot. Now you want variable cost, find out what is 800 into 55%? 440. So 800 minus 440 is 360. 1100 into 40%, which is 440. So 1100 minus 440 is 660. Similarly, 600 into 45%, which is 270. So 600 into minus 270 is 330. So similarly, fine. This is your total variable cost. This is your total contribution. 2500 minus 1150, 1150, 1150 minus 1000 is 0. So that's all. Okay. Come. Okay, good. So this is your break even. This is your break even. That is your actual performance. And this is your budget. Everything is done within your income statement. Income statement should be the focus. Everything is only inside income statement only. Okay, good. So now I'm taking you to the next question. Very big, very important question I'm going to share with you now. Okay. May 2019. This is May 2000. This is two products. Guys, you have to be very careful. You have to understand because this is May 2019 and it is two products. So far, the previous question, this was actually concept. This is actually only one product. This is also one product. This is actually how many products we don't know, but three different geography. Now, company is one, but product is two. Product is two selling price, then everything will be there. So you have to find out number of units to be sold for black and white to break even during financial year, amount of reduction in fixed cost product wise to achieve desired profit mentioned at 4 above. Okay. So the same model. Model is going to be the same, guys. Model is going to be the same. So please look at this question now. This is very, very important. Okay. Because it is multi-product. Okay. And it is multi-product. For each product, separate break-even point. Okay. Separate variable cost. Okay. Good. Now please look at this. Ms. Gaurav, Gaurav Private Limited is manufacturing and selling two products. Okay. Black and white. At selling price 20 and 30 respectively. Very important. The following sales strategy has been outlined for the financial year 1920. Okay, because the question is with respect to 1920 only. So don't bother about the other things. So income statement. Okay, income statement. So this is what I'm going to do. I copy this, paste it here. Okay. I don't want all this. So remove all this. So this is income statement. Income statement of which company? Gaurav Private Limited. Okay. So what I will do? So this is Gaurav Private Limited for financial year 2019-20. So this is income statement. Good. So income statement of how many products? Two products. So we are going to do two products. So what are those two products, guys? The name of the two products is black and white. Okay. The following sales strategy has been outlined for the financial year 1920. So what he says is sales planned for the year will be 81 lakhs. Sales planned for the year will be 81 lakhs in the case of black and 54 lakhs in the case of white. So straight away sales is given. Okay. So this is income statement for black and white. So this is black, this is white. Okay. So this variable cost and contribution, you cannot do like this because if it is a single product, you can put it there. If it is multi-product, you put the variable cost, PV ratio in the vertical itself. So sales has been given to you. How much? 81 lakhs and 54 lakhs. So 81 lakhs. Okay. And 54 lakhs. So this is your sales. The selling price of black will be reduced by 10%. So original selling price, I will have the selling price on top. So what is your selling price? Okay. Oh, selling price. So SP. So selling price was originally 20 and 30, but selling price of bag will be reduced by 10%. So 20 on that 10% will be 2. So the revised selling price will be 18. Then white will be reduced by 20%. So 30 into 20% is 6 rupees. So 30 minus 6 will be 24. Wow. So now, once you know the selling price, you can also find the units. Okay. So selling price, I'll call it as revised. Okay, revised selling price. If you want the original selling price also, you can keep it on top. Okay. Original selling price. So what is the original selling price? 20 and this is 30. But I'm not concerned about this. I'm only concerned about revised selling price. And what is your units? 81 lakhs divided by 18. So 4.5 lakhs. Similarly, 54 lakhs divided by 24. So 2,25,000. Okay, so that is your units sold. Very good. Break-even point is planned at 70% of total sales of each product. Okay. So now, break-even sales. So this is your actual sales. So what is your break-even sales? Now, what is your question? Question is, how many number of units to be sold to break even during the financial year? Oh, so this is your actual sales. So what is your break even sales? So break even sales is said to be 70% of total sales of each product. So that means your margin of safety is 30%. 70% means 30% is your margin of safety. So what we will do, we will have this on top again. So what is your break even sales? Even sales. Break even sales is actually 70% of your actual sales. Actual sales. Good. So guys, you have got it perfectly correct. So on 81 lakhs, 70%. 57 lakhs, 70,000. On 54 lakhs, 70% is 37 lakh 80,000. Now, what is your question? Number of units to be sold of black and white to break even during financial year. So everything is got it. Now break even sales, I will type it as break even point. So what is break even point? So break even point is in units. In units. So just now I discussed before that break even sales always should be up. Now break even point will be 57 lakh 70,000 divided by selling price, revised selling price. You have to be very careful. So it is 3 lakh 15,000 units. Actual unit is 4 lakh 15. Similarly, 37 lakh 80,000 divided by 24. So this is your answer. This is your answer. Break even point in unit. That is what is asked. Number of units to be sold of black and white to break even during the financial year. So this is one. Okay, good. So now you have got this. Amount of reduction in fixed cost product wise to achieve desired profit mentioned at 4 above. Oh, so now 4 is a different. Profit for the year to be maintained at 8,26,200 in case of black, and 7,45,200 should be the profit in case of white. Okay, so profit has been mentioned. This should be possible by reducing the present annual fixed cost of 42 lakhs allocated as 22 lakhs to black and 20 lakhs to white. So he has given two interesting points. The present fixed cost is 22 lakhs and 20 lakhs. Now what he is asking, Amount of reduction in fixed cost product wise to achieve desired profit mentioned at 4 above. Profit for the year to be maintained at 8,26,200. Okay, 8,26,200. Now, I want to actually find out, please, they have given the break-even sales. Okay, they given the break-even sales. Is it possible for us to find, I repeat, is it possible for us to find the contribution ratio, PV ratio, because the PV ratio is the crux here. I repeat, PV ratio is the crux here. Okay. Now, I want to make one small observation, because he has mentioned about profit. Profit for the year to be maintained at 826,200 in case of black, and 745,200 in case of white. So now increase in profit is equal to increase in, I repeat, increase in contribution. Increase in profit is equal to increase in contribution. So we can call this profit as profit to be maintained for what? Profit to be maintained for the sales of 81 lakhs. Okay. Now, all of us, we know the increase in sales is between these two. What is your increase in sales? 81 lakhs minus 5670 is your increase in sales. For the increase in sales, that is equal to the contribution increase, that is equal to the profit increase. And what is the profit increase? He said as 826,200. So therefore, 826,200 divided by your change in your sales will be your PV ratio. Very, very important catch. This catch is very important, which I am going to do it now. Please look here. I am going to make two more columns. This two more column is going to change the entire scenario. Okay, this is going to be black. Okay, this is going to be black, the full. Okay, so what I will do, one column I will do break even, one column I will do actual. Okay, so both are black only. So this is actual and this is break even. So if you are, this is so what I will do, I will say sales. I should call. This is your actual sales. Okay. So maybe I'll take one more column. This is your actual. This is your break-even point. So break-even point sales is how much? 5670. Actual sales is how much? 81 lakhs. So we don't know what it is, but for break-even point, profit will be 0. For actual, the profit is how much? Profit for the year to be maintained 826,200. 826,200. This point is very, very important. Once you have got this point, the problem is solved. So what is your change in profit? That is your change in contribution. And change in contribution divided by change in sales. So what is your PV ratio? Your PV ratio is your change in profit is equal to change in contribution. Your change in profit is 826,200 divided by your change in sales. Your change in sales is that is why your incremental sales is between 81 lakhs and 5670. Otherwise 30% off, because that is 70%. Your change in sales is 30% of 81 lakhs. So 30% of 81 lakhs will be 24 lakhs 30,000. Okay, 24 lakhs 30,000. This point is very important. This is your PV ratio, guys. This is your PV ratio. Okay, it's not given here anywhere. But without this, you can't do anything. So you have got the PV ratio for black. Similarly, you have to do the PV ratio for white. Okay, so this is your actual. So what I will do, I'll add one more thing. This is white. Okay, white break-even point and actual. Sorry. So this is actual. Break-even point is how much? 3780. This is your change in sales. Change in profit is how much? What is your profit for black? 7,45,200. 7,45,200. Wow. So that means PV ratio for Black is 34. PV ratio for white is how much? Change in profit is change in contribution, which is 7,45,200 divided by change in sales. Okay, change in sales is actually 30% of 54 lakhs. So 30% of 54 lakhs, which is actually 16,20,000. Good. So it is 46%. Good. Very, very important, guys. Very important. These two numbers are very important. Now, please look here. On this 34%, this 19 lakhs 27,800. Contribution is what? Minus 1927. Fixed cost is what? The same. Fixed cost is what? The same. Okay. Now, less fixed cost 37,42,200. Now, come to actual. Okay. Come to actual. Now, what is your profit? Profit is 826,200. Now, this fixed cost, I am going to reduce it. What is this? Amount of reduction in fixed cost product price to achieve desired profit. To achieve desired profit. If the same fixed cost is there, it is not possible. So, what we need to do? Okay. What we need to do is the next one. So, let us find out that. Okay. Let us find out that. 20. So, it is 34%. So, what is this? So, variable cost, variable cost is actually, I have made it wrong. So, VC ratio. VC ratio is 1 minus PV ratio, which is 66%. So, this is 66%. On this, 66% is this. Contribution is this. Okay. So, this is 34%. Good. Now, similarly, what is actual? On 81 lakhs, what is variable cost ratio? 66%. What is your contribution? 34%. For your information, guys, you subtract 19 lakhs 27,800 from 2754. 2754 minus 1927,800. Your profit is 826,200. Okay, your profit is 826,200. Perfect. But what was your original your profit? This is your, I will call it as revised fixed cost. Okay. Similarly, what is your revised fixed cost here? Variable cost ratio is 1 minus 46%. So 54%. On 3480, what is 54%? 20 lakh 41,200. So what is your PV ratio? 17 lakh 38,800. So your fixed cost is 17 lakh 38,800. Now here on 54 lakhs, 54% will be 2916. So what is your contribution? 2484. Subtract the 1738,800. So on 24 lakhs 84,000, subtract 17 lakhs 38,800, you get 7 lakh 45,200. Wow. So we have got this. Okay. Now, what is the question? Question is amount of reduction in fixed cost product wise to achieve desired profit. Okay. Now he says original fixed cost was 22 lakhs and 20 lakhs. So this is your revised fixed cost. So what is your original fixed cost? Your original fixed cost was 22 lakhs. And here it is 20 lakhs. So this is your original fixed cost. So he says reduction in fixed cost product wise. So your reduction in fixed cost is equal to 22 lakhs minus 19 lakhs 27,800. So 272,200. This is your answer. 272,200 is your answer, which carries mark. Similarly, 20 lakhs minus your 17 lakhs 38,800. So 261,200. So that is your reduction in fixed cost. So ultimately, you have to only construct this table, Gaurav Private Limited, income statement for black and white. Okay. So this is break-even point. This is actual, break-even point actual. You have to arrive at it. So your break-even point in units is the answer for 1. And this is your answer for 2. Okay. This is your original fixed cost, revised fixed cost. Okay. How you got revised fixed cost? Only by preparing break-even point. Otherwise, revised fixed cost you will not get it. Okay. So, guys, with this, I must thank each and every one of you. Very interesting day we have started with. Tomorrow morning, same time, 8:30 a.m. We'll meet once again for yet another topic on cost and management accounting. And I'll also be doing an advanced exam-oriented question. So any point you want to actually share, please share it in my blog. My blog is 3spro.blogspot.com. And those of you who wish to actually form part of that WhatsApp group, please send me a message along with your name, your student registration number, your location, and your mobile number to my mobile number, because there are few admins there. And those of you who wish to be an admin also, you can tell who want to be an admin. Okay. My number is 98401-63269. Okay. So to this number, you have to send your request. So it will be added to your WhatsApp. And don't forget to click the subscribe button. It is a free subscription so that every day you will get the notification. So best of luck. See you tomorrow.